Today, we're going to dive deep into four absolute titans of the dividend ETF world: VIG, VYM, SCHD, and HDV. We're going to dissect their core strategies, put them through a serious stress test, and give you a rock-solid framework for figuring out which one or which combination is right for you. Let's just start with this. This is the central truth that most people miss. Dividend investing is so much more than just chasing the highest yield. It's actually a battleground of competing ideas, hidden risks, and long-term consequences. You see, these four finds pretty much own the dividend space. They're the heavyweights. But here's the critical part. They are not interchangeable at all. Each one is built on a completely different blueprint, designed to do a very specific job for a very specific kind of investor. So here's how we're going to break it all down. We'll start with the big philosophical divide in dividend investing. Then we'll pressure test their performance, and then we get to the 30-year compounding shock. Trust me, you'll want to see this. After that, we'll cover risks, a decision matrix, and our final verdict. All right, so this brings us right to the heart of the matter. This is the fundamental question you have to answer. Are you building a portfolio for cash in your pocket today or for maximum wealth tomorrow? Let's do a quick roll call so we know who's who. VIG is all about one thing: dividend growth. VYM is your classic high-yield, broad market play. SCHD is the hybrid. It tries to give you a bit of both growth and yield. And then there's HDV, the defensive specialist with a big bet on energy. See? 4 totally different game plans. And these different game plans really split the dividend universe into 2. On one side, you've got VYM and HDV. Think of them as the cash today team. They give you a higher starting paycheck, which is great for retirees, but that paycheck doesn't grow very fast. On the other side, you've got VIG and SCHD, the cash tomorrow team. The starting paycheck is smaller, but it's designed to grow and grow and grow. This is for the long-term wealth builder. So before we even look at a single performance number, this is the question. You have to ask yourself, which team am I on? Do I need the income now, or am I playing the long game? Because your answer fundamentally changes which of these ETFs even makes sense for you. Okay, let's get to the data. It's time to put these theories to the test, compare these funds head-to-head, and see what happens when the market gets ugly. This table really tells the story. You can see their unique DNA right here. Check out SCHD's 10-year growth rate, an impressive 10.8%. But then look at HDV's beta. At 0.73, it's way less volatile than the market. That's its defensive nature showing. And you can see VIG's focus on growth with its huge allocation to tech, a sector that HDV basically ignores. Every single number here is telling you about their different strategies. And this brings us to an absolutely crucial point. There is no single best ETF that wins all the time. It just doesn't exist. The data is crystal clear. Leadership rotates constantly. One year it's VIG, the next it might be HDV. Anyone who tells you otherwise is selling you a fantasy. And if you want the ultimate proof, look no further than 2022. That year was a brutal stress test with rising rates. The S&P 500 got hammered, but look what happened here. HDV, with all its energy exposure, was actually positive. Even VIG held up well, but SCHD, the long-term darling, took a hit. This shows you exactly how different environments favor different strategies. Let's just let that sink in. The market regime, the economic environment we're in, is what picks the winner. It's not about which fund is good or bad, it's about which fund is built for the current climate. 2022 proved that beyond a shadow of a doubt. All right, now we get to the most important part of this entire analysis. Seriously, this is where the long-term math reveals something absolutely staggering, and it's the part that I find most investors just completely miss. So let's run a projection. We start with 100 grand. In year 1, things look pretty similar, but just watch what happens. By year 10, SCHD's annual income has blown past the others. By year 20, it's not even a competition. And then, by year 30, the gap is just astronomical. That initial investment in SCHD is projected to be spinning off over $62,000 a year in income. That's the raw power of compounding dividend growth. But what if you don't even spend that money? What if you reinvest every single dividend check? You know, the classic DRIP strategy. Well, the results get even more insane. After 30 years, VYM and HDV turned that 100K into a very respectable 1.5 million. VIG does even better, hitting 2.5 million. But SCHD, with that powerful 1-2 punch of a decent yield and high growth, well, the final number is almost hard to believe. 3.2 $2 million. That's the result from the same $100,000. This single number shows you the profound, literally life-altering power of choosing the right strategy for a long-time horizon. Now, after a number like that, it's tempting to just declare SCHD the winner and call it a day, but not so fast. Every strategy has an Achilles heel, and a smart analysis means understanding the traps hidden inside each of these funds.
So what are the weak spots? For HDD, it's concentration. It's putting a whole lot of eggs in just a few baskets. For SCHD, as we saw in 2022, it's vulnerable when interest rates spike. For VYM, its strength, broad diversification, can also be a weakness, watering down performance. And for VIG, the problem is simple. That low starting yield just isn't going to work if you need income now.
Okay, so what on earth do you do with all of this information? Let's boil it all down into a super simple, actionable decision matrix. This is how you align the right ETF with your specific goal. Here it is. It's really this straightforward. If you're a long-term wealth builder, we're talking 20, 30 years, then all the data points you towards VIG and SCHD. If you need income to live on today, in retirement, then your world revolves around VYM and HDV. And of course, for a lot of people, the right answer might be a strategic combination of both. And that brings us to our final verdict. This is the big mindset shift that I think is so critical for actually being successful with these funds. I want you to burn this idea into your brain. These ETFs are not competitors. They are not racehorses you're betting on. They are highly specialized tools in a toolbox, and you would never ever use a hammer when you need a screwdriver. So the absolute worst thing you can do is just pick one of these at random or because it was popular last year. The best strategy, the one that actually works, is to be a craftsman. It's to carefully select the right tool that is perfectly aligned with your time horizon and your financial goals. The question isn't which ETF is the best. The real question is which ETF is the best tool for me. And just a quick reminder, this analysis is for educational and informational purposes only. It is not investment advice. Past performance certainly doesn't guarantee future results, and you should always consult with a qualified financial advisor to discuss your own personal situation.